Good morning, students. Welcome to Ekcel Academy's CSEET crash course. Today we'll be looking at economics and business environment once again, continuing from where we left yesterday. Before we proceed further, as you can see on the screen, this is an announcement with respect to the CS course and what Ekcel Academy does for CS course. Now, as a student of CS, maybe you are in CSEET stage or executive or professional, whatever, whichever stage you are in, you may have several questions with respect to different aspects of the entire course. Maybe you have questions related to examination, or maybe you have questions related to the admission or training, or what to do after training, or what to do after qualification, all that. So to answer these, we Ekcel Academy have in fact the series, I would say, on all these questions which may arise in a student's mind. So, and that series is called CS Student Questions. I guess there is a playlist, or even if there is no playlist, just check it out. Just search for CS Student Questions and Ekcel Academy on YouTube. You will get a host of videos wherein different students have answered, or they have raised questions and it has been answered by us. So I'm sure it would help you. Just check out the series. Maybe one or two of your questions are already covered there. Anyway, while you are at that, if you haven't already subscribed, please do subscribe to our channel Ekcel Academy on YouTube, and also do register on our website excelacademy.com. The link for which is there in the description. You'll get lots of goodies there, like quick MCQs, quizzes, then mock tests. All these facilities are provided, of course, free of cost. You don't have to pay for that. So take advantage of that. Maybe it will help you in your journey to become a company secretary. Anyway, having said that, let's quickly move on to the syllabus of the day. That is the last portion of our previous chapter. Let's see what else is left. Okay, this is where we had stopped yesterday. Let's look at the major components of revenue and capital budget. Let's start with the revenue budget. Let's see what exactly we have in store here. So revenue budget, they say government receipts which neither create asset nor reduce any liability are called revenue receipts. This, if you are a commerce student, you are already aware of. We have capital and revenue items. They are referring to the same thing. Essentially, these are current income receipts for the government from all sources. Just like we have capital receipts, revenue receipts, capital expenditure, revenue expenditure. So here they are talking about the revenue receipt for government. So for government, what is revenue expenditure? Something which they get over and over, again and again. So that can be classified under revenue receipts. So they say tax is one of the major revenue when it comes to revenue receipts, or plays a major part when it comes to revenue receipts. There also they have classified into tax revenue and non-tax revenue. Let's see what exactly tax revenue includes. Tax revenue will include receipts from direct tax, income tax, which is in the form of income tax, is paid to the government. It will also include various indirect taxes like GST, cess levied and collected by government on various goods and services. So now everything comes under GST. Earlier it was in different forms, but anyway, doesn't matter. What we have to understand here is, when it comes to tax revenue, there are only two major components: direct, indirect. Indirect being GST. Now let us look at the non-tax revenue. So which are those non-tax revenues? It may include receipts from government's disinvestment process, which are nothing but proceeds from the stakes sale in various public sector undertakings, like for example Air India. So until now, government had a stake in Air India. Stake means they had some shares, or rather majority shares. Now that they have sold those shares to someone else, a private player, they will get the revenue out of that by selling the shares. So that also comes under non-tax revenue. Non-tax revenue will also include dividend income which the government receives as a shareholder on various public sector undertakings, of course. So since the government is one of the largest shareholders through various other companies, may not be directly, so it also receives lots of dividend. So that is also a non-tax revenue. So those two are major non-tax revenues, tax revenues being direct and indirect taxes. Moving on. So they say revenue expenditure is also called income statement expenditure. That's okay. Just remember this. You may get this as a question. You never know. Revenue expenditure is also called income statement expenditure. It denotes short-term cost-related assets that are not capitalized. Again, this is the exact opposite of revenue receipt. Something which we get recurringly. Here with something which you are spending on recurringly. It denotes short-term cost related assets that are not capitalized. So if it's a capital asset, then it won't come under revenue expenditure. It comes under capital expenditure. So these are maintenance expenditure which the government makes towards the assets which it owns in order to keep them functioning. So just like any other company or entity, government also will have capital expenditure, revenue expenditure. So this is their revenue expenditure. For example, payment of salaries or pension to its employees or former employees. So all these will not create any asset for the government, but since they were working or they are working to make sure that various assets of government are functioning or maintained properly, the government has to incur all these expenses. And they've also given the example of metro, but metro cannot be considered as revenue expenditure. That's what they say. It will be a capital asset and it will be capital expenditure. Okay, now other major important point here is this. The difference between revenue receipts and revenue expenditure is known as revenue deficit. So if your revenue receipt is less than the revenue expenditure, then there is deficit. That means you have less revenue to cover your expenses. That is the thing. Now let us look at capital budget. So in case of capital budget, again we have different types. One is of course capital receipts, the other being capital expenditure, just like we had in revenue receipts and revenue expenses case. Now let's see what exactly we have here. Capital budget consists of capital receipts and payments. Capital receipts are loans raised by government from public, long-term loans, because we won't be repaying these loans anytime soon. So therefore they are considered as capital receipts. Market loans, borrowings by government from Reserve Bank, again long-term loans, and other parties through sale of treasury bills, loans received from foreign governments and bodies. Basically all your loans which the government gets from different sources can be considered as capital receipt. Then they say disinvestment receipts. Okay, again why did they include it here? Okay, they are including it in both capital receipts as well as revenue receipts. I don't know why. Anyway, recoveries of loans from state and union territory governments and other parties. So just like Government of India receives loan from others, they also dish out loans to various parties like state governments, union territories, etc. And those state governments and union territories will have to clear those loans over a period of time. So when they clear those loans, so that will be considered as capital receipt. Now when it comes to capital expenditure, so they say it consists of expenditure for acquiring assets like land. Let's say the government has to widen the road. Maybe they, instead of 2-lane road, they want to create a 6-lane road, 4-lane road, whatever. If they have to do that, they have to acquire the adjoining farmlands, for instance. For that, they have to make the payment. So that comes under the capital expenditure. Then we have buildings, machinery, equipment, investment in shares, etc. All these are, what is it? Capital expenditure. Now let us look at this concept called fiscal deficit. What is this fiscal deficit? It's nothing but shortfall in government's income compared to its spending. So they have some estimate with respect to income. This is the income which we may earn, and this is the amount which we may spend. If the amount of spending is more than the amount of income which the government is getting, then obviously it is nothing but fiscal deficit. A fiscal deficit is calculated as a percentage of GDP or simply as total dollars spent in excess of income. So how much ever we have spent in excess of income, that will be considered a fiscal deficit, and they will arrive at some percentage compared to GDP. That's okay, that's not a big deal. So once again they are reiterating, fiscal deficit is the difference between the total income of the government and its total expenses. So when does such a situation arise? When the government expenditure exceeds its income, of course. The difference is calculated both in absolute terms and also as a percentage of GDP. Again, they're repeating the same stuff. The recurring high fiscal deficit means that the government has been spending beyond its means. This is something which you often see. Governments promises, they promise so much that they will give you this free of cost, maybe that at a subsidized price. But for any government to do all that, they also need revenue. So where are they getting revenue from? As we just now saw, the sources for revenue are limited. So the means are limited. When the means are limited, you cannot give freebies beyond your means. So when the government does that continuously, then there will be a recurring high fiscal deficit. That means every year you will have the same fiscal deficit. How long will you borrow money from RBI to cover this fiscal deficit? Anyway, the elements of fiscal deficit, how can fiscal deficit arise? One, it could be revenue deficit, meaning government's current revenue is less than its current expenditure, or it would be capital expenditure also. If there is too much of capital expenditure and too little of capital revenue, then also we will have fiscal deficit. So again, they have just given various sources here. No need to get into that. We have already seen different sources. Okay, they have given a table wherein we have some data with respect to actuals. Government of India data. This is actually, they are not given the source though, no? Yeah, let it be. We'll assume that this is the actual one. Revenue in 2017 was 18,78,833 crores, whereas if you look at the expenditure, it is more than the revenue. So when that is the case, there will be fiscal deficit because we have more expenses than revenue. So in fact, if you look at every year, the same thing is happening. So compared to the revenue expenditure, our total this is revenue total now. My mistake. So revenue expenditure and revenue receipts. So this is the comparison. So if you look at this, 1878,833 was our expenses, whereas our income or revenue receipts is only 1435,233. Even if you look at the capital expenditure and capital receipts, there is some deficit. So there is not even a single year in the recent past where we haven't suffered a revenue deficit. Every year we have been suffering a revenue deficit. Every year the expenditure is more than the income or the receipt. So that's why we have been having a deficit. So here is the net total. So 4,43,000. Then it came down thankfully in 2018-19 to 4,16,000. Then 410 further decrease. But again there was a sharp jump in 2019-20 to 4,85,000 crores. So now so they have given a percentage of GDP as well. How much deficit are we incurring every year as a percentage of GDP. So then this is the fiscal deficit. Then again percentage of GDP. Primary deficit, again percentage of GDP. All these calculations you can just check it out later on. Not a big deal. So this is the actual data. No need to remember any of this stuff. I mean, whatever is there in this table. So all that you need to understand is, it is not so easy to overcome revenue deficit because, as I said, the government has various wants or needs wherein it has to spend on so many things. For instance, COVID. Because of COVID, the government had to spend a lot on various measures to make sure that we didn't suffer like countries like China, where people are literally fighting for food. Anyway, so now let's move on to the next chapter. You have some sample questions. The answers are also mentioned there. Please go through those. If you register for our course free of cost on our website for CSEET, you will get notes as well. You will get chapter wise detailed explanation. So if at all you want that, I would still suggest you just go through that process. Anyway, let's move on to the next chapter, which is the Indian financial markets. A very interesting chapter, but there's so much data here. So as much as possible, I'll try to cover everything, but there are certain things which are fairly self-explanatory. That means if you just read it like a story, you will understand. Such things I'll simply skip. And wherever I feel that the institute may ask a question based on a fact or something of that sort, I'll try to mark it so that you could also know what exactly the institute may or may not expect. Let's proceed further. Overview of Indian financial system ecosystem. The financial system of an economy is a crucial element for its economic development. Okay, stating the obvious. It facilitates the flow of funds from households. This is very important. It facilitates the flow of funds from households, like your households and my household, to business organizations, thereby assisting in creation of wealth for the nation. This is very important, and that's how any financial system should function. For instance, let's say you have like 4 or 5 members in your family. Maybe all of them are earning. You are still a student. So what will they do with their savings? So they have income. They will have expenses like household expenses. After that, they will have some savings. Now, there are different ways of utilizing that savings, but how to make sure that that savings which any household has actually goes to invest businesses, so that they can use this money to make sure that they build their business and in turn return the same to the investors, either in the form of dividend or in the form of wealth creation. So once again, let me just simplify this thing. You save maybe in the form of shares. Maybe you want to invest in shares, or maybe you want to invest in mutual funds. Now, where will that money finally end up? It'll end up in corporate houses, companies basically. So what will they do with that money? They will build their business. By building their business, they're actually building the nation. So when they contribute towards taxes and other stuff, the government will also get more money. And at the same time, you as an investor, you will also get more returns. Either you will get returns in the form of increase in the share value, or you will get returns in the form of dividend. Both are beneficial for you as an investor. So this is what the financial system of a country is concerned with. So let's see what are those. Allocation and mobilization of savings. So how do we mobilize savings? The savings is spread across various people and spectrum of individuals. So now we have to mobilize that and make sure that it is channelized to some place wherein we can make sure that that is used for wealth creation and building of nation. Provision of funds, facilitating the financial transactions, developing financial markets, provision of legal financial structure, provision of financial and advisory services. All these are mere words, doesn't really make much sense unless you understand anything. Don't worry too much about it. Okay. Next, important features of a financial, again not required. There is too much of data here. Let's see if we can use anything here. Again, let's skip this part. I wouldn't want to spend too much time on that. Noteworthy developments in Indian financial ecosystem. Let's look at this. Rising incomes are driving the demand for financial services across income brackets, they say. Okay, again stating the obvious. Oh my goodness. How much do they do this? Financial inclusion drive from RBI has expanded. Again, see, the point with these type of statements is, yeah, it makes little sense unless you back it up with hard facts. So all these are statements which look more like opinions. So one thing which I can see here is this: Maharashtra has launched its mobile wallet facility. See, basically what the government should do is they should make sure that if you have money, it should be easy for you to channelize to various channels. Like you want to invest in shares, it should be easy for you to do that. If you want to invest in mutual funds, it should be easy for you to do it. The government should not create hundreds of procedures which instead of encouraging, rather hinder the entire investment process. So now thankfully, due to few private players, we really have such easy means to invest in share market or mutual funds. So thankfully, to in fact, government also has done certain things like UPI, which makes transfer of money very easy. So there is something which has facilitated a lot of financial transactions over a period of last 2-3 years, ever since I think even before pandemic. No, we had this UPI. Yeah, of course. So after the demonetization, I believe. Anyway, so now there are certain measures which have actually encouraged people to invest a lot, but at the same time, you should also understand that still we have not reached a level wherein we can easily say we have removed all the hurdles. If you want to invest, you can easily invest. No, we have not reached that stage. Of course, there are certain ways in which you can still do that, but there should be some kind of active participation, or let's say proactive measures from government as well. So all these statements again are mere statements. For example, they say credit, insurance and investment penetration is rising in rural areas. How do we know? Do you have any facts? Where are the facts? If you say simply rising in rural areas, how much was it earlier? Let's say 1. How much is it now? Let's say 5. This is how we will know that it is rising in rural areas. If you simply say rising in rural areas, it doesn't really make any sense. And you should also not be unduly worried or take anything of that sort seriously. Again, if you look at the first statement, they say rising incomes are driving the demand for financial services. Absolute bullshit. It may be true, but you don't make such a statement unless you back it up. So back it up with solid proof. That way it is easy for students to understand. So I hope Institute realizes all this. Fairly unlikely, but there is no harm in hoping for the best. Okay, see here there is a fact which is good. Lower mutual fund penetration of 5 to 6%. So what they are trying to say is mutual fund so far has penetrated only to the extent of 5 to 6%. That's all. When that is the case, there is still a lot of opportunity for us, because look at the vast population of the country. If only 5 to 6% of the people have invested in mutual fund, there are so many others who haven't already invested. So we can definitely tap that market. So this gives us some kind of hope. Then investment corpus, total investment by various people, whether it is corporate or non-corporate, individuals or non-individuals, in Indian insurance sector can rise to $1 trillion by 2025. They say it's an estimate, of course. Next, Maharashtra has launched a mobile wallet. All that is fine. Yeah. Okay, this is interesting. Government has approved new banking licenses. How many? They have not mentioned. They could have easily mentioned. And increased the FDI limit in insurance sector. From what to what? They simply say increased. Did they increase from 1 rupee to 10 rupees? No, obviously not. But they could have provided that info as well. Anyway, let's move on. Banking sector. Let's read a bit about banking sector. The banking industry handles finances in a country, including cash and credit. This we know what banks do normally. See, banks generally what they do is they accept deposits. Once they accept deposits, they are supposed to pay interest unless it's a current account. And more people usually go the savings account route. Now, even if they accept deposits in the form of fixed deposits also, they are supposed to pay interest, in fact, higher interest. Now, if banks keep on accepting deposit and if they are liable to pay the interest, where will they get the money from? Unless you have some source, unless you are utilizing all those deposits to earn some income, there is no way you will be able to service your expenses. Expenses being interest which you are supposed to pay to the fixed deposit holders, savings bank account holders, all those people. So to do that, what the banks do is they lend money. They lend money in the form of loans, and those loans usually carry a higher rate of interest compared to the interest which the bank gives to its deposit holders. So whatever is the difference, that is the bank's profit. So that is basically the job of any bank. Okay, it's not just one bank. Every bank does the same thing. So now we have different types of banks here: commercial banks, small finance banks, payments bank, cooperative banks. So earlier we had a we didn't have these classifications earlier, but like now we have small finance banks, now we have payments banks. All these are recent things. In fact, payments banks more recent than any other. So let's look at commercial banks, which are the types of banks which you are aware of mostly. So commercial banks, again, we have in commercial banks also we have public sector banks, private sector banks, foreign banks, and RRBs. Okay, commercial banks are regulated under Banking Regulation Act 1949, including public and private, even foreign banks. They all come under the same Banking Regulation Act of 1949. Okay, but one major thing which you have to remember is earlier most of these banks like Canara, Syndicate, Vijaya Bank, they were all private sector banks, but the government back then nationalized all these banks, and now more than 75% of the total banking business in this country is nothing but public sector banks. Okay, so okay, next, small finance banks. This is a niche segment in the country and is aimed to provide financial inclusion to sections of the society that are not served by other banks. Basically, all these commercial banks, what they do is they will usually serve all these corporates or where they can make more money. But what about those people who also need money but who may not be able to pay high rate of interest, but still they are ready to pay interest? That means there is scope for anyone to actually make money there, but these commercial banks are not interested. So enter small finance banks. So that's one of the unique features of small finance banks is they serve all those people who are not usually served by the commercial banks. So who are the main customers of such banks? Micro industries, small and marginal farmers, unorganized sector entities, and small business units. Okay, these are licensed under section 22 of the Banking Regulation Act. Okay, so these in the sense small finance banks. But the point which you have to understand here is all these people, that is marginal farmer who may not have too much of land, or some micro industry who may not even have more than 10 by 10 shop. So these people also need money, but they need less money. They don't need crores of money. They may need 1 or 2 lakhs. So who will fund them? Small finance banks. Now enter payments bank. This is a relatively new invention. So it was conceptualized by RBI and is allowed to accept a restricted deposit. That means you can only accept deposit up to a certain amount, not more than that. If you accept more than that, you can't accept more than that. So it was okay. They also offer services like ATM cards, debit cards, net banking, mobile banking. So which are those payment banks who can accept a restricted deposit? India Post Payments Bank, that is managed by the India Post, a Government of India enterprise. Fino Payments Bank, Paytm Payments Bank, Airtel Payments Bank. Next. So what are the things which a commercial bank can do and a payment bank can't do, or the traditional banks can do and the payment banks can't do? So we'll only look at the not so common area. A payment bank cannot provide loan or involving lending activities. Payment banks cannot issue credit cards, whereas a commercial or a traditional bank can issue. Okay, and when it comes to payment banks, there is a limit of rupees only 1 lakh per individual customer. More than that you cannot have that as deposit. Then we have cooperative banks. Just read nothing much. Okay, this is interesting. History of banking sector in India. First we had a closed market in 1921. Then we had state-owned Imperial Bank of India. Only one bank. That's all. That's why it's called closed market. No other private players were allowed. In 1935, RBI was established as the central bank. Then quasi-central banking role of Imperial Bank came to an end. Because we had only one bank, that bank itself functioned as the central bank. Then in 1935, government thought it fit to start a new bank, so which could serve as a central bank of the country, and that being RBI. Imperial Bank expanded its network to 480 branches. So between 1936 and 1955. So finally they converted that from Imperial Bank to State Bank of India. That's how we know that bank today. But it was the first bank in the entire country. That is in 1921. So this is very important. As I said earlier, government nationalized all these banks, private banks, which were hitherto private banks, but later on the governments nationalized and made sure that they came under the government control. So when did the government nationalize? They nationalized 14 large commercial banks in 1969 and 6 more banks in 1980. So, but if only government banks are there, if only public sector banks are there, then there won't be any competition. They may not render service which will attract the customers to them, because they're not accountable basically, because they will anyway get their salary whether or not they do their job. When that is the case, it's difficult to attract customers. So then once the private players started entering the banking sectors, like ICICI, HDFC, then the government banks realized we cannot be sleeping like we had been all these years. So we'll have to up our game. Otherwise, all the new customers will simply move to government banks. So, of course, the higher the competition, the more the competition, it's always good for the customers. The same principle applies here as well. 2000 onwards, in 2003, Kotak Mahindra Bank, or rather Kotak Mahindra Finance Limited, received a banking license from RBI. So it was NBFC, and now it received a banking license. It was the first NBFC to be converted into a bank, non-banking finance corporation, which got converted into bank. Okay, again, all these are facts. I'll just not go there. See, you read it. I'm not going there, but if you read it, you will understand a lot of things, because this will give you a better picture than mere statements. But since it's a fact, there's nothing for me to explain. That's why I'm just skipping that part. That's it. Mutual funds first phase was in 1964 to 87. Second phase 1987 to 1993. So then third phase, what exactly happened with respect to mutual fund, how it has grown over a period of time, you can notice here. In spite of all this, the penetration is still very low. So that might give you an idea as to how well the mutual fund has actually grown or not grown. So compared to the share market. So just go through that once. Then comes the insurance sector. Okay, this is interesting. Insurance sector, like banks until sometime in late 90s, was controlled by the government. Only government companies could get into insurance sector. But then they opened it for private players in the late 90s, and since then, so we have had many insurance companies come up. Even there, the coverage is very less. So very few people compared to the overall population have actually taken up the insurance, whether on their life or any of their properties. So let's see what exactly we have in store here. Insurance industry of India consists of 57 insurance companies, of which 24 are in life insurance business. Okay, the companies which insure a person's life, and 33 are non-life insurers. Okay. Among the life insurers, LIC is the sole public sector company. This is very interesting. Up to a certain point, it was only the government company which had or which could give you or offer you insurance. Now it's only one out of 24 life insurance companies in the entire country. Okay. Apart from that, among the non-life insurers, there are 6 public sector insurers. Okay. Apart from that, everything else is private, like New India Assurance. Then there are various other companies which are owned by government who are into non-life. Like if you want to get your vehicle insured, you usually approach such insurers. Anyway, let's move on. Market size. Government's policy of insuring the uninsured. So there are, as I said, so many of our population, majority of our population is not insured. So the government has been striving actively to get them into the insurance fold. So that's why there is some increase in the insurance penetration. Gross premiums written in India reached 5.53 million. That means that's the amount of premium which people have paid in financial year 18. Okay. In 19, it increased by 3.66%. They say the latest data is not here, unfortunately. I am guessing it would have increased more during pandemic because people were trying to get insurance against COVID as well. So that would have surely contributed to some extent towards the premium. Government initiatives. Again, these are different initiatives to boost the insurance industry. We have National Health Protection Scheme. Ayushman Bharat is something which you would have heard of. So this has a huge capital expenditure here. Then we have over 47.9 million farmers benefited on Pradhan Mantri Fasal Bhima Yojana. Okay. All this can be read easily. Just go through that once. Not very important. Okay, we'll take a break of a couple of minutes and then we'll quickly move to the other aspects. Welcome back. Let's look at the major events in the journey of Indian insurance sector. 56 to 72, only we had LIC, and then we had non-insurance business, which were also nationalized in 72. Then Malhotra committee recommended opening up the insurance sector to private players. As I said, in the late 90s, so we had Insurance Regulatory Development Act was passed in 1999, which in fact opened up insurance for private players, so ending the monopoly of General Insurance Company and LIC. Until then, only those two were there. Post-liberalization, the insurance industry recorded significant growth. Number of private players increased to 46 in 2017, they say, but still very small number compared to other industries. Then there was this Atal Pension Yojana, very famous pension scheme introduced by the government in 2015. Then we had National Health Protection Scheme, which is proposed to be launched under Ayushman Bharat, and it was also launched. Okay. Anyway, not very important there, but this is important when it was left open for private players in 1999. Again, these are the new age companies entering the insurance sector. Like even Flipkart has entered the insurance space apparently, along with Bajaj Alliance, to offer mobile insurance. That is interesting. Insurance for your mobile phones as well. Amazon India is also expected to enter the insurance market as an agent. Think of any company, they would all be interested in the insurance sector because you have the list of, the database of customers who are already procuring or getting some service from you. So push this as well. So it will be easy for you to convert your existing customers to insurance customers. Something which even SBI has been doing. If you visit any SBI branch, they will push for all these insurance schemes, because you are their customers. You already have some kind of relationship with them. So now you trust them. So they would expect you to get insurance also from them. So that would be easy for banks to push instead of pushing to some stranger. I won't get into all this. Let's move on to public and private sector banks. This all can be easily read and understood. So there's nothing much to explain there. So now let's look at public sector banking, or rather banks. The banking sector was developed during British era. Okay. British East India Company set up 3 banks, which are those: Bank of Bengal, Bank of Bombay, and Bank of Madras. 3 different locations, but they all got merged into Imperial, and Imperial then came to be known as State Bank of India. But Reserve Bank of India was started in 1935. Try to remember the dates here, especially this. When was Reserve Bank of India established? And also this. When was State Bank of India named as such in 1955? Until then it was there already, but with a different name. That's it. In 1969, what the government did was they nationalized all these banks. Which banks? Bank of Maharashtra, Dena Bank. All these were private banks, but now they became nationalized bank. Punjab National Bank, Syndicate Bank from Karnataka, Canara Bank again from Karnataka. Then we have Indian Overseas Bank, Indian Bank, Bank of Baroda, Union Bank, Allahabad Bank, United Bank of India, UCO Bank, Bank of India. Oh my goodness. So many different banks were nationalized. That happened in 1969. But subsequently, they nationalized few more banks. So that happened in 1980, I guess. Yeah, 1980. So which were those banks? Andhra Bank, Corporation Bank, New Bank of India, Oriental Bank of Commerce, Punjab and Sindh Bank, and Vijay Bank. So these were also nationalized. Including State Bank of India and its associates, the number of public sector banks rose to 28 in April 1980. Until then, we had only State Bank of India and its associate banks as public sector banks, but rest of them were all private banks. But now that the government has nationalized in 1969 80, most of them became public sector banks. Next. Okay. What they are trying to say is, despite opening up of the sector to private entities in early 1990s, public sector banks remain formidable players. Of course, yes. Many people trust only the public sector banks. They don't open an account in private sector at all, because they feel it's a government bank. Their money will never go anywhere. So that's a feeling which they have. It may or may not be true. Their overall market share, even now, is a significant chunk. If you look at that data, so 66.9 or 67% at the end of financial year 18, in spite of so many years, the private players haven't been able to capture even 50% of the market. In spite of the shoddy service by the government banks, we still have people knocking on their doors. Okay, what can anyone do about it? Okay, they say, while some PSBs means public sector banks, such as SBI, PNB and Canara Bank are lumbering giants, so banks with huge customer base, they did not balk, they did not cry or complain when it was time to adapt to changes in the financial system and customer requirements, embracing retail banking and technology with gusto. They say, the textbook says here that all these banks embraced the retail banking technology with enthusiasm. But if you are an SBI customer, you will know how horrible and shoddy the bank's service is. If someone tells me that SBI service is very good and they are adapted to technology, they will definitely disagree with such statement, because it's worst when it comes to technology adaptation. If you look at the private players, if you look at other banks also, for instance Canara Bank, they're far better compared to SBI. So there is no comparison at all. So if you visit SBI bank also, you will know how horrible their service will be in bank. So every time you visit a bank, I hope that you never get to visit SBI bank. But if at all you have to visit that bank, for some reason you'll have to end up waiting a lot because their servers don't serve at all. Anyway, so it's easy to make statements here in the textbook, but the reality is slightly different, or rather hugely different, especially when it comes to SBI. Okay, now the government recently, what they did was they merged a few of these public sector banks again into 4 different entities. So why did they do? Mostly because of economics of scale, I believe. But yeah. Basically, they say for greater reach. Okay. The largest of the mergers announced is that of Punjab National Bank with Oriental Bank of Commerce and Union Bank. That means Punjab National Bank was a separate entity, Oriental Bank of Commerce was a separate entity, Union Bank was a separate entity. They all got merged together, amalgamated together, and now it will be only known as Punjab National Bank. So now it became the second largest public sector bank in India after SBI. Okay. So then they also announced the merger of Canara Bank and Syndicate Bank, two different banks from Karnataka, now only known as Canara Bank. Okay. So then they also announced the merger of Indian Bank and Allahabad Bank. So that is there. So which are the private banks which are there since a long time? Catholic Syrian Bank, you would have seen these banks somewhere or the other. City Union Bank, Dhanlakshmi Bank, Federal Bank, again a very popular bank from Kerala. Jammu and Kashmir Bank, Karnataka Bank, very old, one of the oldest banks. Karur Vaishya Bank, Lakshmi Vilas Bank, Nainital Bank, Ratnakar Bank, South Indian Bank, Tamil Nadu Mercantile Bank. So all these are very popular banks actually. So these are all the private sector banks, of course. Then we have new private sector banks. These are all old private sectors. The new age private sector banks being since 1993, Axis Bank, DCB, HDFC, a very popular bank of course, ICICI, again a very popular bank, IndusInd, Kotak Mahindra, Yes Bank, IDFC. Yes Bank again has been in some kind of turmoil since some time. The government of India had to pitch in to make sure that bank was recapitalized so that they would have sufficient funds to carry on their services. Bandhan Bank of Bandhan Financial Services. So this is a special bank which was started recently. Then we have small private banks. We have already seen what the small finance or small private banks do. They take care of services which normally all these old and new private banks as well as public sector banks do not usually end up doing. For example, giving loans to marginal farmers, micro industries, small industries, etc. So which are those banks now? Ujjivan Small Finance Bank. Again, do you have to remember all this? Not necessary. I hope they don't ask any questions based on this because it will be simply a case of memory test then. But one thing which I want to stress here is Equitas Small Finance Bank. This is interesting because one of those banks which has been growing steadily since some time. It is a Tamil Nadu based bank. Why I feel that is interesting is this is a bank which was actually started by a company secretary. So check out about that Equitas Small Finance Bank. You may find the bank interesting. Even their services are good if you ask me. Now, okay, these are all about different types of cooperative banks and rural development banks, regional rural banks. Sorry, I won't touch upon that, but instead I will directly go to types of shares and debentures. So because these are all fairly self-explanatory, then there's too much of data there, which is good, but there is nothing for me to explain there. So please go through all this. So, and wherever there is any information which you feel can be asked as a question in the exam, just underline that so that it'll be easy for you to revise a day before the exam. So all you have to do is just look at those underlined points which are related to facts. If it's not related to facts, don't underline, because it will be of no use. Simply you'll be wasting your time giving attention to such stuff. Anyway, let me move directly to types of shares and debentures. See, how will anyone raise money? If you need significant chunk of money, you have to have a private limited or a public limited company, preferably public limited company, so wherein you can issue shares and people may subscribe to the shares of your company, and through that your company will be funded. So how do they do that? Of course, you if it's the first time for you, then it's called IPO, initial public offer. You make an offer to public wherein you tell them about your proposal. So you will tell what exactly you have in your mind is in the company's mind, as to how would you like to spend the money which you intend to get through the investors in the form of IPO. So that will be there in the proposal, prospectus, whatever it is. So then if enough number of people actually like your proposal, they may invest in your company, and then they become the shareholders. If they invest in your company and if they become the shareholders, then they're nothing but owners, part owners. Even if someone has one share, that person is owner to the extent of that one share of a company. So that is one way of raising money. Of course, there are different ways as well. If at all someone doesn't want to share their ownership, they'll raise money through debt. Okay, anyway, we'll come to that. Let's see what exactly is mentioned here. So equity shares or ordinary shares. Okay, different types of shares. The shares which we often see are equity shares, wherein you directly become the owner, wherein you don't get any preference when it comes to payment of dividend or at the time of liquidation. Whereas the other type of share, which is the preference share, as the name itself says, it will give you a preference. What kind of preference will it give it to you? It will give you preference with respect to dividend payment, meaning you will get dividend earlier to the equity shareholders. That's all. That's the only preference which you are getting, not earlier to others. Or at the time of liquidation, you will get money sooner or earlier than the equity shareholders. That's it. Because it's not like you'll get first before anyone else. No, first the secured creditors, then various other parties will get their money at the time of liquidation, and finally before the equity shareholders, you as a preference shareholder will get the money. Now these are the two different types of shares. Whichever type of share the company wishes to issue, they will issue, and most of the companies, majority of the companies in fact, issue only equity shares, and you get equity shares and you become the part owner. If you have enough number of equity shares, you can even take decisions on behalf of the company, because if you have so many shares, you can influence the company's decisions as well. If you have observed carefully, you would have seen what is happening with Twitter. Twitter is it's still a private limited company, but now recently a serial entrepreneur named Elon Musk, who is actually the founder of Tesla electric motor vehicles. So he bought a huge stake in Twitter. He bought 10%, nearly 10% of Twitter. Now he has some say in matters with respect to what Twitter wishes to do. In fact, he offered to buy the entire company for some $45 billion or so by purchasing their shares. So basically, if you own equity shares, you become the owner. If you own enough number of equity shares, you can drive the company through your own decisions. That is the thing. Now, when it comes to equity share capital, there are different types of capital. Let's see what are these. We have first the authorized capital, meaning the maximum amount of capital which you as a company can raise. See, we can raise money either through IPO, that is first time initial public offer, like what happened with Paytm. Paytm wanted some 16,000 crores. How did they raise that money? They raised that money through IPO, initial public offer. Now, if Paytm once again wants to raise such amount of money, I doubt so many people will be interested in investing in Paytm right now. But still, if at all they want to invest or rather raise money again, they have to do through follow on public offer, FPO. So that is the thing. So offers in future to the public. Now, once authorized capital has been decided, you decide usually at the time of registration, incorporation. You cannot exceed beyond this. Your share capital should be less than or equal to the authorized capital or nominal capital. No, whatever is your authorized capital, it need not be your issued capital. Meaning, my authorized capital could be 100 crores, but I may not need 100 crores right now. I may issue only, let's say, 75 crores right now. Even when I issue 75 crores, okay, let's say enter 75 crores is subscribed. That means I invite public to buy shares worth rupees 75 crores and people have subscribed. Now, if at all I'm calling upon people to invest in these shares in installments, then I may ask them to pay the money of 75 crores in 2 installments. Let's say I have now asked them to pay 37.5 crores only. So this would be the paid up capital. So what is the authorized capital? Maximum amount of capital which a company can raise. Then we have the issued capital which the company has actually issued to public for them to subscribe. If public subscribes for the entire amount, then it will be called subscribed capital. And in that there will be paid up capital, meaning how much the company actually wants right now. Right now I only need 37.5 crores. That is the amount which the shareholders have paid. Unpaid would be remaining 37.5. Right shares. Right shares are those shares which you get as a right for having owned already few shares of the company. Let's say I already have some 1,000 shares. If the company wants to further issue shares, then what it will have to do is it will have to first offer to me, the existing shareholder. It will give me a right to purchase shares in proportion to the shares which I already have right now. So I may buy those shares, or that means I may exercise my right or I may not exercise my right. Basically that. Sweat equity shares usually given to employees who have sweat hard for the company. That's why it's called sweat equity shares. Even for promoters also. Usually it is given at a discounted price. So they have explained the same thing again here. Let's not bother. Then we have preference share capital. I've already told you how it differs from equity share capital. Then there are different types of preference share capital. Cumulative preference share capital means even if your dividend is not paid this year, next year it will get accumulated. Non-cumulative preference shares, your dividend will not get accumulated. If this year I didn't get the dividend, next year I won't get the dividend. Whatever was not paid earlier is gone forever. Okay. Redeemable preference shares, something which will have to be repaid after certain point of time. Participating preference shares, meaning those shares which participate in the surplus amount of profits and get dividend. Non-participating preference shares, they won't get such extra dividend. Convertible preference shares, those preference shares which can be converted into equity shares. Non-convertible, obvious, it won't be converted. Then we have debt. If at all you are not interested in issuing shares, you can issue debentures, which is nothing but debt, and raise money. So now how is this advantageous? Very simple. If you issue shares, what will happen is they become the shareholders and they will try to influence decisions, like what is happening with Twitter. Now instead of that, if you issue debentures, they only become debenture holders, or rather they become the lenders and not the owners, but still you will be able to raise money. But the point with, or rather the disadvantage of debentures is you'll have to pay interest. Whether or not you as a company is earning profits, you'll still charge against the profits. It's not the appropriation of profits. Okay, here also we have different types of debentures: secured, unsecured. Secured means the amount which has been raised as debentures will be secured against some asset. Normally, we only issue secured debentures, not unsecured. Then we have redeemable debentures. Redeemable means after some time, let's say 10 years, 20 years, it has to be returned to the debenture. Holders, whatever money you have received from them. Then we have irredeemable debentures. Irredeemable means there is no fixed time frame. Here we'll have 10 years, 15 years or 20 years. Whereas in case of irredeemable, they are also redeemable, but there is no fixed time frame as such. Instead, usually during liquidation, those debentures are redeemed. That means whatever money is owed to the debenture holders, that is returned. Then we have fully convertible debentures, meaning whatever debenture is there, it can be converted into equity shares. Likewise, we have partly convertible, meaning only some part, maybe half of that is convertible. And then we have non-convertible, something which cannot be converted at all. Okay, then this financial assistance and scenario for small and medium enterprises and startups, Sfurti, scheme of fund for regeneration of traditional industries. Again, this is a very new thing, wherein if you own a traditional industry like maybe hand making, like what is that, handmade fabric, maybe khadi manufacturer, then you will get funding from organizations like this, that is scheme for regeneration of traditional industries, Sfurti. So they have certain criteria. If you fulfill that criteria, you will definitely get money from such financial institutions. Again, there are few more such institutions which do the same thing for different categories. Not very interesting. You can just read it on your own. It's just hard facts. Okay, that's all for now. We are done with chapter 4 as well. In the next class, we'll move on to chapter 5, which is Indian economy. Fairly interesting chapter. So we'll complete that chapter in the next lesson whenever we meet again. Tomorrow, as usual, the class will resume at 7:30. We will have law class, I'm guessing, tomorrow. So before we wind up, let me make another announcement. So if at all you wish to contact us with respect to any query, with respect to any stage of CS course, all you can do is WhatsApp us on this number 973-973-3400. Just ping us. Someone from our team will definitely get back to you with respect to your query. So we are easily accessible. Do WhatsApp us. You don't have to call us also. Some people may not prefer calling, so for them it is easier to reach us. So take advantage of that as well. Anyway, thank you for joining. See you tomorrow at